Boom.
Right. There we go.
Lovely, lovely. How are things?
Did it.
You did. Impressive, impressive. Um, Pleasure to see you guys. Thanks for making time. And yeah, this is a super special moment for me and for you. You guys have now paid your home off. It's been quite the journey, quite the
Yeah.
journey. So
It sure has.
yeah, I've unbelievably impressive numbers. I mean, what you guys have achieved in that period of time is phenomenal. So, did you know that you owed around about $294,000 in January 2020?
Was it really?
Yeah, $294,000 is what your balance was in January 2020, and you paid that down to zero by January 2024.
That's unreal.
Wow. Now I am super impressed.
Yeah. And so, do you know what you've just done there?
No. Something awesome.
Yeah, you've paid $294,000 off your in 4 years.
That's unbelievable, but we wouldn't have been able to do it if it wasn't for you.
Yeah, that's for sure.
I appreciate that, but you guys have just worked so hard. You've stuck to this strategy, and $294,000 off your home loan
I know.
does that seem believable? I mean, who
No,
say
it doesn't. There's no way in the world we thought we'd be able to do that. No way.
I could see?
Yeah.
Jen had a bit of confidence in it, but I was always sort of reluctant to, something will usually come up or something and it holds us back a bit.
Yep.
Yeah.
No, I was determined.
Yeah.
Yeah, I mean, you both were.
Yeah.
So with that, I mean, I'd love to sort of hear a little bit about your story before you met me. If you can cast your mind back to what your life was like. I remember there was a few loans here, there, and everywhere, and sort of why you reached out, and then we sort of fast forward to Dream the System, why you or how you think it helped you the most, or why you thought it did help you, considering what you were doing before we sort of set things up, and then how you're feeling now with this future ahead of you.
Well, I'll tell you our story really. Back in 1985, 86,
Yeah.
85, when the interest rates were up to nearly 19%, we actually lost our home, our car, everything we absolutely owned.
Wow.
We lost every single bit.
Wow.
And we ended up having to rent with my brother. And we had to do that for years. And eventually, many years later, I finally talked Moto into giving it another go and building a house.
I was always scared to do it again because we were sort of younger and lost everything at one stage. One child then. And then one on the way. And we were living in 2 rooms at Jen's brother's place.
Yeah, so that was our start to having a house. It was really horrible time, but we did end up building again, and we made a bit of profit out of that. We sold that one and moved here to Kingston and bought another one that wasn't quite finished. We sold that in the boom, and then we rented for a couple of more years after we sold that because we didn't know where we wanted to go, but we ended up buying this place that we're in, which needed a lot of work, and I mean a lot. Yeah. But we've actually got it now to a finishing stage where it's a beautiful home. Wow. So from what we came from to what we are now, we honestly could not have done it unless we had come across you. Yeah. Honestly, we didn't think we'd ever own a home again, and particularly before retirement.
Yeah, yeah. We're sort of, with my last position, my last job, and the start of the one I've got now, we were living pay to pay, more or less. We we had a few cards here and cards there, and outstanding sort of debt. And in that time that we were put onto you guys, we're really proud of ourselves, and we really thank you guys, from the bottom of our hearts.
Yeah. I mean, it's something where to retire debt-free changes everything.
Yes.
Yeah.
Yes,
Because
definitely.
more
Yeah.
than 50% of people in your position are retiring with a mortgage.
Yeah, yeah, we've heard that. I've sort of done a little bit of research, and I like to look into things.
Mhm.
And yeah, I was amazed at how many people just do not own their own homes, and
Yeah.
they never do.
No.
Yeah.
Yeah,
And so they're in a position which, if we never met, you'd be in a position where you're going to retire, and then all of a sudden you've got to use your super fund to pay off what's left on your mortgage.
yeah, yeah,
And
yeah.
the average Australian pays 10,000 a year off their mortgage. So since 2020, when we spoke, where you had a mortgage rate of about 294, you'd have still 250 owing on it today.
Yes, yes.
And
Wow.
that means your
Wow.
super would have been 250 less.
Yes, yeah. Wow.
Yeah.
Yeah. Oh,
So
that's awesome.
Yeah.
it is
Unbelievable.
awesome.
Yeah, we've been on a bit of a high since you told us that we've done.
As you should be. It's one of the greatest achievements in life to own your home. It's the
Yes.
great Australian dream.
Yes, yeah. And we're sort of in the last few months where we were tossing up whether we need to sell it or what we need to do, but we're happy where we are, I think, and we're
Yeah.
staying. Yeah,
Absolutely.
yeah.
Yeah.
And
So this is it.
really good. And with the strategy that we put in place, the money management system, how do you feel it helped you the most?
It was in every aspect of it. It was that control and making you see what you're actually doing and keeping that control under control. Yeah.
Mhm.
Yeah. Actually, it was, I just found it absolutely perfect.
Yeah. And
Honestly.
the way the bills and that were paid, we didn't have to look at it and say, oh, that's due. It was just all coming out.
Yeah. Yeah. I honestly, I can't praise you enough.
Yeah.
Yeah.
No, I can't praise you guys enough. I mean, something where we've got every 23 days I get to call a client and say, this is where you're at, this is what you've done. And no one's sort of hitting those numbers of 294 in 4 years. That's like 73, 74 grand a year on average debt reduction. I just told you, what's the average payoff per year? 10,000.
Yes, yeah. Like,
and what are you averaging per year paying off your house? 74,000 a year.
Yeah.
So
Wow.
a lot of hard work, obviously, from both you guys to get to this. A lot of hard work, but now everything changes. We've got all this salary. If you decide to continue working, I mean, how much longer do you reckon you're going to work for?
I'll probably retire next year.
Amazing.
I'll be 67, so I've got to use up all my long service and annual leaves and all that sort of towards the end of it.
Mm-hmm.
Yes.
With that, you'd probably know, towards the end when I am going to retire, is it best to use your long service and then retire, or is it best to get that paid out when you leave?
It's a good question. What you want to do is, because it's about the tax year, right?
Yeah.
That's right. Yeah.
So if let's say you retire in June, then you want to start taking your long service leave as of July, that new financial year, because then everything sort of is going through those different tax brackets.
Ah, right. Yes. Because that changes, doesn't it, in July?
Yeah. And so what you want to be doing is, because if you took a lump sum, then it's going to be taxed on top of your income you've already earned for the year.
That's right.
And as a result, it's going to be decimated. So yeah, if I was in your position, I would say, okay, I'm going to work up until June and then retire, but not like retire, but I'm now going on long service leave for a year, or however long you've got on long service leave. So then that income starts the new tax year, you start getting taxed on that, and it's increments. Like the first 18 grand is tax free, the next sort of 12 grand is taxed at this percent, and so those tax brackets move up. But that means it's starting from a clean slate. Whereas if you put that lump sum on top of your income that you've already been taxed on for that tax year, and let's say you got to end of June and you're like, okay, I want my lump sum up front, and they say it's 120,000. Now your income's $120,000 more, and you're losing 40 cents, 45 cents in every dollar.
Yeah. Okay. Yeah.
Oh, that's a good idea. Yeah.
That's definitely a conversation you should be having with HR and say, show me the numbers. Show me the numbers, and if I take this a lump sum versus if show me the numbers on what this would look like if I took it as long service leave or annual leave, and it's paid monthly as you get paid, or fortnightly as you get paid at the moment.
Yeah.
That's a good
Okay.
idea. Yeah. Yeah. No, that's excellent. And you know, with our Macquarie,
Yep.
is that best left as it is until he actually retires?
Yeah, so once he retires, then it needs to be turned into pension mode. And so everything sort of changes once that happens, where it turns into pension mode. That means you can start to draw funds out of that tax-free. But one of those things which you should be doing is once you do finish work, then actually, because you've got no debt, so you should be putting all that money into super. And so you should be maxing out your super contributions with that long service leave income. So it's all salary sacrificed into super, and whatever you can't, once you hit that limit on what you can salary sacrifice into super, then you're taking that as income. But you should be maxing out your super contributions for both you guys with that income.
Okay.
So
Right.
they're using the money to go into super because you don't have a mortgage anymore. So what's the money?
Yeah.
Like, there's no point you putting it in your bank account sitting there earning no interest. So it's better to go into your super fund, so that you can actually have it growing, but also it's going in at 15% tax rather than your marginal tax rate.
Ah, okay.
So
All right.
yeah, best to salary. So once you do finish working and you take that income or long service leave, then you want to say, I want to salary sacrifice maximum, and then whatever's left after I've salary sacrificed the maximum, then pay that to me as income. And then once that runs out, then you retire, put it into pension mode, and then you start pulling out whatever you need to continue living.
Okay. Awesome. So we need to get in contact with Macquarie once he's ready to
Yep,
leave. Yeah.
Yep.
Okay then.
that's it.
Oh, awesome. Oh, brilliant.
Yeah. So
Oh.
yeah, you guys are set for life. Set for life.
Now, yeah, now that it's been paid, there's a lot of changes
Yes.
happening. How come? What's the go?
So
Like,
what's happened is the banks have been told by the government, if anyone is a victim of cyber security or fraud, there was $3 billion last year that Australians lost. The government said, you're on a hook, bank. And so the bank's like, well, if we've got a scam artist who hooks up a direct debit to your home loan and then can rip all your redraw out from a direct debit, the bank has to pay you. And so the bank's like, we're not taking that risk. So we're not allowing any more direct debits on the home loan as of March, end of March. So
yeah, 24th or something, I think it was.
yeah, so from you guys, you're going to obviously start now putting the salary into your spending account. You're then going to change all your direct debits to come over out of your spending account. We can leave the loan facility open so it sits at a zero balance, and we can use that if we ever needed to in the future, but it's not costing us anything to keep open. But yeah, we're going to need to start redirecting salary into your spending account and then start changing over your direct debits to come out of that spending account.
Okay then. All right. Yeah, because we don't know whether to get a new car or not, or whether just to keep the one that we've got. We own that. We own everything now. So we still don't know, undecided. If we wanted to do another car, is it best to leave it with you guys and then draw down on the loan?
Yep.
Yeah. Okay. All right. Yeah, really undecided. Yeah.
That's definitely the option. I mean, you'll be able to knock that car off in no time, but yeah, that would be the smartest way to continue doing that.
Yeah.
So if that's the case, you just need to switch your direct debits over to your spending account.
Yep. Okay then.
And just redraw extra for those expenses.
Yeah. Okay then. So when do we have to have our
March
if we
24th.
decide to keep it? So we've got to get his salaries sent over to our savings account.
Only if you're not going to do the car.
Only if we're not going to do the car. Okay then.
Yeah. So if you're doing the car, then I mean, might as well just leave everything going into there, switch all your direct debits over, and then just pay that car down ASAP. And then once that car is paid, then we switch the income to go into the spending account.
Okay then. So All right. So I've got to get a list of what direct debits are coming out now.
Yeah, I can send you a list of all your direct debits. I'll send
Oh,
you a
could you?
statement with every direct debit that's come out over the last 12 months.
Oh, lovely. And then what do I need to, if we leave it as it is at the moment, I just send through a request, but because on that letter it states that it can be rejected, any requests, is that the case?
No, I mean, like it's your money at the end of the day.
Yeah,
You've got access to it at whatever stage, especially if your loans debt free, which it will be once if you do or don't do this car.
yeah.
Yeah, those funds are going to be fully available at all times.
Okay then. Awesome. What do you reckon on a car? Do you reckon wise to keep what we've got, or?
Oh, I don't know, you guys. I've always said drive the cheapest car your ego can afford, and so it's something where it's not smart, obviously, financially, to be putting money into liabilities which go down in value. I'd much rather you put that same money into assets that go up in value. But you guys have paid your house off, so you're free financially, and if it's going to make you very happy buying a car, then just do the car, and it is what it is. Like it's
Right.
a lifestyle call. I mean, I'm telling you, it's not smart financially. You know, it's not smart financially. But you don't have a home loan, so it's like, okay, well, we can be now probably to start to look at these life luxuries which we've said no to before because we've been so focused on paying the house off.
Yeah. Okay, no, that's good. I'm glad you said that. That's good.
Yeah.
Yeah.
This is really now about, once this is all sort of clean, whether we paid the car off, etc. We've then maxed out the super, and once you guys stop working, your mindset needs to shift to, okay, we've gone through the accumulation phase. Now we need to go into the spending phase. And what I mean by that is the name of the game is to spend every single dollar you have before you die. Like, it's not about saving money anymore. Like, this is like, okay, this is how much money we've got. Let's try and get through this and make sure that happiness is our North Star. And if it makes us happy, we're doing it. We're buying it. We're paying for it. We're doing the experience, whatever it may be. If it doesn't make us happy, we're not doing it. And so, like, I just don't want you left with money at the end of it because it's just been wasted. Like getting through it. And so what's going to happen is you'll retire, and in that first 10 years, you'll be spending a lot more. But those second 10 years, like 77 to 87, man, you're getting pretty tired, not spending as much. And once you finish all of your spending, i.e. you blew all the way through your super fund, there's two options there. This mortgage is going to stay until 2046. So you've got access to draw on this and live, like, use this to fund your lifestyle until you die. Or most people get a reverse mortgage because they don't have this set up. Basically, the bank will lend you 15-20% of your house value. You don't have to pay any repayments on it. So the name of the game once you retire is, okay, we've got to get through our super, then blow all of our equity, and then we're still on a pension after all that happens at like $500-600 a week.
Yes.
So you're not going to run out of money. Things are going to be fine, and start living.
Yeah,
definitely. Yes. Yeah, because we very rarely go away, very rarely take a holiday, do nothing. We haven't done for a long time. As I said to Mono, it's about time we start.
It is about time. Yeah, it's time to start living. Like, I know, like, it's weird hearing this from me because I'm so much save money, pay down,
Yeah.
We're flipping the script now. You've got to the finish line. You've finished the first challenge. Now the next challenge is to spend everything you've accumulated. That's the game.
Yeah.
Which is the great. This is heaps
It
more
is.
fun. This game.
No, it's awesome.
Heaps more fun.
Yes.
Yeah.
Oh yeah.
So that's really, so mindset. Okay, we're going to blow through our super. Once we blow through the super, then we've got the loan, which we can draw upon the equity that you've created. And once all that's done, then we've got the pension. Things are fine, you know?
Yes.
Fine. Like, you're not going to have to worry about money.
Yeah. No, that's awesome. Good thinking.
Yeah.
Well done. Thank you.
No problem. Absolute pleasure.
You cleared my mind.
Again.
Yes.
Again. Brilliant. Okay, so I just want one last favor from you. Can you tell me, tell me, because I just want to record this, saying we paid $294,000 off our home loan in 4 years.
we paid $294,000 off our loan in 4 years.
Yippee!
Ah, well done. Congratulations. That's
Thank
unbelievable
you.
pace. I mean, it's like it's so good, it's unbelievable. It's
Yeah.
mind blowing.
Yeah. Yeah. Smiles on our faces for the rest of the day now.
Yeah, it's for the rest of your lives. For the rest of your
Yeah.
lives. Like you've accomplished something which is like most people don't. So congrats. You've come from so far behind, but you finished so far ahead. And what an absolute comeback. What a comeback story.
Yeah.
So yeah, thanks for sharing that. Congratulations. Let me know what you want to do with the car. That's
Will
always
do.
on the cards. But yeah, let's start booking some trips. Let's start having some fun in the sun. And then, yeah, if and when you are looking to tap out, okay, we've got all this long service leave, it's going to be probably smartest just to reduce the tax on it, that you don't take it as a lump sum in the same tax year as you've been earning all your income. It then starts to trickle through as just an income like you were working, but you're on annual leave.
Yeah. Okay.
But stack that super fund. Like everything should be going as much as you possibly can into Macquarie now. And so
Yeah.
that's a
Because
conversation.
Macquarie's set up as a retirement fund now, isn't it?
No, it's not in pension mode. So
Okay.
it's in accumulation mode, but as soon as he stops working and there's no more contributions going in from his employer, then you call
Then you've got to
Macquarie,
keep
say,
it.
Macquarie, we've stopped working now. Can you please turn this into it's called a pension mode. And
Okay.
then you just want to start pulling money out of that tax-free.
All right then. If I get stuck and forget something, can I
Of course,
have
yeah.
to call you?
I mean, we're getting divorced, but we can still catch up for coffee.
No divorce.
Just a
It's amicable.
separation.
It's amicable.
Typical.
Absolutely, we can. Yeah, whatever you need, whenever you need it, I'm here.
Oh, lovely. Thanks, Scott.
No
Yeah.
worries.
No, honestly, you have been a godsend.
Yeah.
Mm.
And the rest of your guy.
Oh,
people,
the crew's absolutely brilliant.
Yeah.
Yeah. Yeah.
Yeah. There's always someone there to
Yeah.
answer questions.
Yeah. No, they've been really good, actually. The whole lot of them.
I'll pass that
Yeah.
on. Thank you so much. We appreciate you choosing to do business with us. We appreciate you trusting us with your money. And yeah, now it's time to party and have some fun.
Yeah, for
Perfect.
sure.
We'll do that tonight.
Yeah, you better. You better. See you soon.
Okay,
All right.
thank you very much.
Don't forget the direct debits for me.
Yeah, I'll do that
Send
now.
them through.
Okay.
Awesome.
Okay. Bye.
Thanks, Scott.
See ya.
Bye.